In the academic world, it's sort of accepted that active management is extremely difficult. Even if there are skilled active managers, it's hard to identify the good ones, that didn't just get lucky before the fact. And we know that outperformance tends to mean revert. And so it seems difficult to succeed at active management as an investor. It's great for the managers because the underperformance is after fees, so they're still able to make a living, but it's the clients that suffer. Now, my research when I was in the academic world was mostly about behavioral finance, and it was the intersection of quantitative strategies and investor psychology, and trying to avoid making mistakes, but also exploiting mistakes that other investors make. So I think we can make an exception in markets where there's a lot of behavioral mispricing, and so in developed markets, I think pursuing passive management, buying an index tracking fund, or maybe employing smart beta, so that you're sort of tilting toward things that we know have characteristics that have tended to outperform historically. That makes a lot of sense, doing it at a low cost. But in emerging markets, and in particular in a market like China, active management makes more sense because most of the traders in many emerging markets are not sophisticated institutions doing lots of research, applying the sort of accounting expertise. In China, 85% of trading today is amateur investors. And it's not so much fundamental research as it is social gambling. And that creates lots of mispricing. And that's something that active managers, that's a robust source of alpha. And this is something that we've documented empirically. We've looked at different emerging markets and studied how retail investor participation maps to alpha. And for quants, this is something that's pretty easy to do because we can apply quantitative strategies, systematic strategies in these markets. And you do find a correlation where in developed markets, those quant strategies performed well a long time ago, but gradually that alpha has been competed away. And so now in developed markets, there's not so much alpha available to these simple quant strategies. In emerging markets like China, there's a lot of alpha to simple quant strategies. And our approach at Rayliant is to move beyond that and actually apply more sophisticated models and strategies that are tailored to individual markets, that are tailored to unique aspects of China.